Silver just dropped 8% in a single session. 8%. Let that land for a second. We're talking about a metal that just weeks ago was being called the most undervalued asset on the planet. Analysts were screaming about a historic breakout. Retail investors were loading up. And then, boom, gone. Like someone pulled the rug out from under the entire rally. But here's the part that should make you stop everything you're doing right now. At the exact same moment silver was getting crushed, the Iran ceasefire talks that were supposedly calming the Middle East, they're cracking. The diplomacy is falling apart in real time. So let me ask you something directly. How does a peace deal breaking down cause silver to crash? Shouldn't geopolitical instability push precious metals higher? That's what every textbook says. That's what every financial news anchor tells you. But that's not what's happening right now. And that disconnect, that paradox, is exactly where your money is at risk. Whether you've got silver coins in a safe, an ETF in your brokerage account, or you're just watching this wondering if precious metals are even worth it anymore, you need to hear this. Because there is one price level, one single number, that will decide whether this bull market in silver survives or whether we're heading into something a lot darker. So what is actually going on? Let's break it all down. Look, to understand why silver just collapsed, you have to understand two converging forces that most mainstream media is completely ignoring. Force number one, Iran. Here's the backstory. For months, back-channel negotiations between the US and Iran have been quietly progressing, aimed at some kind of limited nuclear deal or ceasefire framework tied to regional de-escalation. The Biden-era framework was abandoned, but under the current administration, there were whispers of a new deal structure. Markets priced in a risk-off relaxation, meaning traders started betting that Middle East tension was going away. That bet just got obliterated. As of this week, senior Iranian officials walked back key terms. The IAEA, that's the International Atomic Energy Agency, released a confidential report flagging that Iran has accelerated uranium enrichment past levels consistent with civilian use. Meanwhile, drone activity near the Strait of Hormuz has picked back up. That strait, by the way, handles roughly 20% of the world's daily oil shipments. Think about what a disruption there does to gas prices at your local station. Think about what it does to the cost of shipping every single product on the shelves at Walmart. Now here's where it gets counterintuitive, and this is what they don't talk about on CNBC. When geopolitical risk spikes suddenly, the first reaction in markets isn't to buy gold and silver. It's to sell everything and grab dollars. Traders rush to liquidity. They cover their margin. They de-risk fast. And silver, being a smaller, more volatile market than gold, gets hit hardest and fastest. That's force number two. Forced selling by institutional traders who were over-leveraged on the silver rally. Think about it this way. Imagine you borrowed money to bet that silver was going higher. You're sitting on a nice profit. Then the Middle East blows up, your broker calls for more margin, your other positions are dropping, and you need cash now. What do you sell first? Your most liquid, profitable position, silver. That's what happened. Hedge funds, commodity trading advisors, leveraged ETF rebalancers. They all hit the sell button at the same time. And a market that was already stretched from a big rally, it doesn't take much to start the cascade. Wall Street knew this was coming. Main Street is just finding out now. But that's just the beginning of what's happening here. Let me connect this directly to your money. Because this isn't just a chart on a screen. This is your purchasing power, your retirement, your family's financial future. Here's the thing. Silver's crash doesn't happen in a vacuum. It's a symptom of something bigger moving underneath the surface of the American economy right now. First, let's talk oil. Brent crude jumped nearly 4% on the back of the Iran ceasefire collapse news. West Texas Intermediate, the US benchmark, followed right behind. Now, gas prices were finally starting to ease. The national average had dropped to around $3.28 per gallon, according to AAA's most recent data. That relief? It's about to reverse. And if you think gas prices are just a pump problem, they're not. Every single thing you buy is touched by transportation costs. Groceries, Amazon deliveries, restaurant food. The ripple goes everywhere. The Bureau of Labor Statistics, BLS, confirmed in their latest CPI report that food-at-home costs are still running about 2.1% above last year. That doesn't sound huge, but stack that on top of the 20+% cumulative grocery inflation since 2020, your dollar at the checkout line
line is not the same dollar it used to be. Now here's where the Fed comes in. And if you have a 401k, pay attention right now. The Federal Reserve has been holding the federal funds rate in the 5.25 to 5.50 range. They've been data dependent, watching inflation, watching jobs, and every time it looked like a cut was coming, something happened. Inflation stayed sticky, jobs stayed strong, and now with oil threatening to spike again, the Fed's hands are tied. What does that mean for you? It means mortgage rates stay elevated. The 30-year fixed is still hovering near 7% according to Freddie Mac's latest primary mortgage market survey. It means your home equity line of credit is expensive. It means carrying credit card debt, which the New York Fed says has hit a record $1.13 trillion across American households, is crushing people every single month. And your 401k, the S&P 500 has been resilient, sure. But if oil spikes, inflation reaccelerates, and the Fed is forced to keep rates high longer, growth stocks and rate-sensitive sectors take the hit. The retirement accounts of 60 million Americans feel that. This is not a conspiracy. These are the actual numbers, but that's just the beginning of what's happening here, okay? Now, I want to take you somewhere most financial YouTube channels never go, because to really understand what's happening to silver and what might happen next, you need to understand how this market actually works. This is what they don't teach you in any personal finance class. There are two silver markets running simultaneously, and they are increasingly disconnected from each other. The first is the paper silver market. This is COMEX, the commodity exchange in New York. This is where futures contracts are traded. The overwhelming majority of these contracts are never settled in physical silver. They're speculative bets. And on COMEX right now, the open interest, meaning the total number of outstanding contracts, was sitting near multi-year highs before this drop. When sentiment flips, those leveraged longs don't exit gracefully, they stampede, and the paper price crashes hard and fast, completely disconnected from what's happening in the real world with actual silver supply and demand. The second market is physical silver, coins, bars, bullion. And here's what's interesting. Dealers across the United States are reporting continued strong demand on physical product even as the paper price drops. The U.S. Mint's American Silver Eagle sales data has shown persistent retail buying throughout recent pullbacks. Now, why does that matter? Because it creates what's called a premium expansion. When the paper price drops but physical demand stays strong, the premium, what you pay over spot price at a coin dealer, goes up. So paradoxically, the cheaper the COMEX price gets, the more real people are paying for actual silver in their hands. Here's another layer: central banks. In 2023 and into 2024, central banks bought gold at near record levels, over 1,000 metric tons, according to the World Gold Council. Now, silver isn't primarily a central bank metal, but the industrial demand story for silver is something that doesn't get enough attention. Solar panels, electric vehicles, 5G infrastructure, semiconductors, medical imaging equipment, silver is in all of it. The Silver Institute's most recent World Silver Survey projects a structural supply deficit, meaning demand exceeds mining supply, for the fourth consecutive year. You can crash the paper price. You cannot change the laws of industrial supply and demand. And here's the kicker: ETF flows. The iShares Silver Trust, ticker SLV, saw significant outflows during this sell-off. That's institutional money leaving. But historically, when ETF outflows hit extreme levels during silver corrections, it has marked some of the best entry points in the metal's history. I'm not telling you to buy right now. I'm telling you to understand what you're actually looking at, because that's just the beginning of what's happening here. All right? This is the section I want you to really focus on, because I'm not here to hype you up or scare you. I'm here to give you both sides, the full picture, so you can make a real decision about your own money. Let's start with the bull case. Here's the thing. The fundamental argument for silver has not changed because of this crash. If anything, for a long-term investor, it's gotten stronger. Supply deficit, industrial demand growing, central bank gold buying, which historically pulls silver higher in its wake. A Fed that will eventually cut rates. And when it does, real yields drop and hard assets explode. A US dollar that, despite its current strength, is structurally weakened by $34 trillion in national debt and deficits running over $1 trillion per year. Add in the Iran wildcard. If the Middle East truly destabilizes, if oil disruptions hit, if a broader regional conflict emerges, at some point, the safe haven trade rotates back into metals with full force. And when that happens in a market with thin physical supply, the move is violent to the upside. The bull case says this 8% drop is noise. The structural story is intact. The smart money is watching the $28 to $29 support zone. If that holds, this could be the last great buying opportunity before the next leg higher. Now the bear case. And I'm going to be equally honest here. The bear case says silver is in trouble for one core reason: the dollar isn't going anywhere. If the Fed is forced to keep rates high, or worse, raise them again, the dollar strengthens further. A strong dollar crushes commodities priced in dollars. It makes silver more expensive for international buyers, reducing global demand. The bear case also points to China. China is the world's largest industrial silver consumer. And right now, China's economy is showing real stress. Property market collapse, deflationary pressure, weak consumer spending. If China slows further, the industrial silver demand thesis takes a serious hit, and there's a technical bear case. If silver loses the 28-hour level convincingly on a weekly close, the next meaningful support isn't until the 24 to 25-hour zone. That's another 10 to 12% lower from here. For a retail investor who bought near the recent highs, that's a painful position to hold. If you're in stocks, ETFs, or physical silver, both of these cases live in your portfolio right now. You need to know which one you're betting on and why. But that's just the beginning of what's happening here. Look, here's what I want you to do right now. Get out a notepad or screenshot this section, because I'm going to give you the exact catalysts and dates that will decide which direction this market breaks. In the next 72 hours, watch Iran. Specifically, watch for any official statement from the Supreme Leader's office or from Iran's foreign ministry regarding the nuclear talks. If they formally walk away from negotiations, expect oil to spike another $3 to $5 per barrel immediately. Watch the USDX, the US dollar index. If it pushes above 106.5, silver faces more near-term pressure. Also watch COMEX, open interest data, updated daily. If open interest keeps falling as price drops, that's capitulation selling. The market is flushing weak hands. That's actually bullish for what comes next. Over the next 2 to 3 weeks, here's your watch list. Number 1, Fed speakers. We have multiple Federal Reserve governors on the speaking calendar. Any hint of rate cut timelines moving forward or backward will move metals instantly. Number 2, CPI report. The next consumer price index release will either confirm that inflation is cooling, giving the Fed room to cut, or it'll show re-acceleration driven by oil. This is the single most important data point for precious metals right now. Number 3, U.S. mint sales data. Watch American Silver Eagle and Gold Buffalo coin sales figures. If retail Americans are buying into this dip, that's a signal the physical market is absorbing the paper market's weakness. Number 4, the $28 level on silver spot. This is the line. Weekly close above $28, bulls survive and likely accelerate. Weekly close below $28, expect a retest of $24 to $25 and a much longer consolidation. And one more thing nobody is talking about. Watch silver's ratio to gold. The gold-silver ratio is currently stretched above 85 to 1. Historically, when this ratio is this extreme, silver eventually outperforms gold violently on the way back. It's happened every single cycle for 40 years. Here's what changes everything: a simultaneous Iran escalation plus a dovish Fed pivot signal. If both happen within the same 2-week window, silver could recover this entire 8% drop and then some in a matter of days. Conversely, Iran stabilizes, oil drops, Fed stays hawkish, and China data disappoints, then $24 is a real possibility. You now have the map. The territory is yours to navigate. I want to talk to you directly for a second, not as a market analyst, just person to person. Here's the thing about moments like this. Most people see an 8% crash in silver and they do one of two things. They panic and sell, or they freeze and do nothing. Both of those reactions are driven by emotion, not strategy. And emotion is exactly what the institutional traders want from you. Because when you panic and sell at the bottom, they're the ones buying from you. This is the moment most people miss. The American middle class has been conditioned to think that volatility means danger. But for an informed investor, volatility means opportunity if you understand what's driving it. Right now, the driving forces are geopolitical uncertainty, institutional deleveraging, and a Federal Reserve that's stuck between inflation and recession. None of those forces are permanent. All of them are cyclical. The dollar in your pocket buys less every single month. That's not a talking point. That's the CPI data. The national debt doesn't shrink. The deficit doesn't go away. And the industrial demand for silver, in solar, in EVs, in the technology your kids will grow up using, doesn't disappear because of a bad week on COMEX. What this moment calls for is not panic. It's clarity. Know what you own, know why you own it. Have a plan for both outcomes, the bull case and the bear case. And do not let a 72-hour geopolitical news cycle override a strategy that's built on years of structural fundamentals. Whether you're a 45-year-old with a 401k wondering if you should add silver exposure, or a 27-year-old buying your first silver coins, or a small business owner watching your input costs rise and your margins shrink, this is the exact moment where financial education pays off. Most Americans won't see this coming until it's too late, but you're here. You watched this far. That already puts you ahead of 90% of people making financial decisions right now. Stay informed, stay grounded, and don't let fear make your decisions for you. All right, before you go, let me ask you something. Right now, are you buying this silver dip? Holding cash and waiting, stacking physical, or have you already moved out of metals entirely? Drop your answer in the comments below. I read every single one. And honestly, your real-world perspectives help shape what I cover next on this channel. If this video opened your eyes to something the mainstream financial media isn't covering, hit that subscribe button. Because what we do here is connect the geopolitical dots to your actual money, not theory, not abstract, your 401k, your savings, your future. That's the mission of this channel, and we're just getting started. Hit like if you saw this silver crash coming, or at least if you're glad someone explained why it happened and what comes next. And send this video to someone you know who holds silver, gold, or is just trying to make sense of what's happening to their money right now. You might be doing them one of the biggest financial favors of the year. Now, here's what I'm watching for the next video. There's a development happening quietly in the US Treasury market that almost nobody is connecting to the gold price right now. And when the connection becomes obvious to Wall Street, it'll be too late for most retail investors to position themselves. We'll have that breakdown for you very soon. Until then, stay sharp, stay informed, and protect what you've built. I'll see you in the next one. Hey, just a quick but important note before you go. Everything in this video is created purely for educational and informational purposes. Nothing here is financial advice, investment advice, or a recommendation to buy or sell any asset. Every person's financial situation is different, and before you make any investment decision, whether it's silver, gold, stocks, or anything else, please consult a licensed financial advisor who knows your specific circumstances. Past market performance, no matter how compelling it looks on a chart, does not guarantee future results. The analysis in this video is based on publicly available information and independent research. Do your own due diligence, always.